Hi, this is Jim. In this video, I will talk about 3 primary myths I have heard about the Kaizen plan. Do you have that family member that is a professor of everything? The financial industry is no different. Just like a divorce attorney should not be giving you advice on estate tax strategies, no one financial advisor can be highly knowledgeable in all areas or strategies. There are over 1 million life insurance advisors in the U.S. Only about 1,000 are approved to represent the Kaizen plan. The only advisors that can have a knowledgeable discussion of how the plan works are agents registered to represent Kaizen, and all reps have signed a selling agreement. Personally, I've been working with NIW, the plan designer, for about 14 years. At the time, I compared premium finance firms, and they were the only firm that had real stress testing and used reasonable projection based on sound economic historical modeling. I wrote my first traditional premium finance case with them 13 years ago, which is still on the books and performing beautifully. So where do these myths come from? Well, if you can't slay the dragon with knowledge and truth, some will battle by creating confusion. So keep in mind the source of what you are being told. Incorrect information usually originates from advisors who don't truly understand Kaizen. With so much marketing now being done on the internet, integrity can be compromised. There are incorrect narratives without accountability. Whether intentional or an uninformed mistake, this creates disruption and confusion. Who wins? Really no one. The client loses by missing an opportunity that might have been a very good fit. Okay, here we go. Myth number 1, Kaizen has hidden fees. This is simply not true. There are no hidden fees, period. Banks and insurance companies that participate in Kaizen will not allow any type of non-disclosure. The only expense outside the policy is to the trust company. This is disclosed and reflected specifically in all proposals. Myth number 2, earnings projections are artificially high. Well, I agree it may seem that way because when leveraging is designed correctly, cash value growth is substantially increased by using other people's money. That is exactly the point of using leveraging. A video will be up soon called Does Leveraging Work? The plan starts with only the most competitive products and with companies that will allow the designers to reduce expenses even more, including the restructuring of commissions. Each state board of insurance controls the earnings rate that can be projected on any life insurance product. Participating insurance company software is integrated so each plan reflects the additional bank premium and accounts also for the loan. Lenders and insurance companies do their own oversight to make sure all is done correctly and per regulation. All parties have a stake in making sure each plan succeeds. Myth number 3. Another advisor said his insurance company does not participate in Kaizen because the loan is too risky. Well, NIW has used some of the largest international banks over 20 years. They did not think so. With over $5 billion in bank funding and a 20-year successful track record, NIW has set the standard on how to do bank leveraging correctly. The Kaizen stress tests use the Great Depression and high-interest borrowing scenarios and is actually more extreme than the testing done by participating insurance companies. What insurance company would not want premium dollars that will stay on the books for years? Typical for cash value life is about a 70% drop-off in the first 3 years. I think mostly from poor design from the onset. Kaizen has 100% persistency. Many IUL products on the market simply cannot pass the stress testing scenarios required to participate in the Kaizen plan. Charges may be too high, and some products lack design features such as term blend that are needed to put more money into the client's pocket. And I will be posting a video on term blend. Also, representatives must be willing to spread out their first-year commissions over several years. This keeps substantially more money in the client's pocket in the first years. I've been asked the question, why not whole life? Whole life is a great product for some situations, especially older clients. All products have their place, but no one product is a fit for all strategies. With whole life, you are paying for guarantees of 2 to 4%, and sometimes this is warranted. One of the largest cases I've written was whole life, but for Kaizen, IUL is a much better fit. Instead of paying for low guaranteed earnings, the money can be used to participate in market options to take better advantage of market growth, and you still do have a zero floor. Good policy management and using different indexes for different economic conditions are some of the necessary elements for success. Kaizen has an entire team dedicated to policy renewals. The policy cash value provides all collateral, and the bank is literally funding its own collateral. And we all know that banks do not extend low rates for risky loans. What is the upside? The typical increase in benefits is from 60% to 100%. This can only be achieved with leveraging. What differentiates Kaizen leveraging from traditional premium finance? Well, for the client, there's no credit checks, no loan documents, no personal guarantees, no interest payments, and no credit reporting. In my opinion, the additional funds that are working for you in the policy from the bank leveraging more than offset any inherent risk. Well, that's it for today. You can check out the NIW playlist for podcasts that talk about why a bank would want to fund the Kaizen design. I hope you learned something, and there will be more videos on Kaizen myths as I come across them.